So we wait for a few more people to join and start in about a minute. So let's start. Welcome everybody to our webinar on angel investing. The goal of today's webinar is to give you an overview on what angel investing actually means, and I'm gonna show you some pitfalls that you can avoid and give you some statistics to show you what it means to be an angel investor. And towards the end, we can also take some questions from the audience. You will all get the slides that I show afterwards in a separate email. And my name is Thomas Diebendorfer. I'm the president and co-founder of SIGTIC, the leading angel investor club in Switzerland. Now, angel investing can have quite a big impact. If you look at SIGTIC in Switzerland, in the last 12 years that we've been operational, our investor community has financed more than 400 different startups, and they together created around 10,000 new jobs. I was also involved in an initiative where startups that have the target market Africa was the focus. It's called Launch Africa, and there in the last 8 years, we could finance 180 startups which have employees in one of the African countries, and they could employ around 80,000 people. So with angel investing, basically you give entrepreneurs a chance to produce a new business or a new product, and also, of course, you're going to create new workplaces. On the way of doing that, with SIGTIC in Switzerland, we have received a few awards. One of them was the Swiss FinTech Influencer Award from Finanz und Wirtschaft. In 2023, we were the first organization in Switzerland to do investor events around financial technology startups, or fintechs as they're called. We were also mentioned several times in Bilanz as digital shapers, and SECA, which is an association in Switzerland that looks at private equity. They nominate each year the Angel of the Year, and in 2024, this award was given to me as the Angel of the Year. Now, so you have a better idea on who is talking to you. I'm the president and the co-founder of SIGTIC, which is the leading angel investor club in Switzerland. I'm also involved in a dorm room fund called Student-to-Student Ventures, or S2S Ventures, where basically students invest between 25,000 and 50,000 into other students that are about to incorporate a startup. So that's even earlier than what we do at SIGTIC, when normally the startup is already incorporated. I studied at ETH Zurich, computer science, and also did a PhD, and I've worked in Silicon Valley with HP Research Lab, and I've also been with Google for 7 years, and I've seen Google grow in Zurich from 40 people to 1,400. Nowadays, mostly an angel investor and a board member in various companies. And on the right side, you see some of my portfolio companies. I co-founded 9 startups. 3 of them I could exit in the meantime: Spontex, Contovista, and Yes. Contovista and Yes were in the financial technology field. Spontex is a a social network, you could say, where basically people post events and you can get to know new people. I'm also involved in a startup called Frontify, which has more than 300 people, and they look around brand management for big brands like TikTok or Anthropic or UBS or Nasdaq or Lufthansa or Visa or Nestle. I'm involved in education technologies as well with Get More Brain and in cybersecurity with ThreatRay and some others. You also see some more of my exits, for example, with Beekeeper, which is a software for communication for large teams, which are spread out at different locations, or Endream, which brought entertainment into cars, mostly gaming, or Carbon Delta that looked at climate change and how to measure climate change, how it affects assets of companies. And with that background, basically, you see that I'm very deeply involved in startups in Switzerland, but they all have a global market. And I try to help them basically from day one when they want to shape the idea into a product and then finding product market fit and then scaling up their businesses globally to become market leaders in their fields. Then let's start with a quick poll of our audience. I would love to understand how many startup investments have you already done? And you should get now a little window where you can pick between the four options. So make your choice and submit. Currently, we have 31 attendees, so I think we can now close the poll and look at the results. So big majority, 63% have never invested. So for you, it's all new. Then some people already have done one investment or 2 to 5, and very few have done more than 5. So most of you here for the first time, I assume, how to invest in a startup, and that's exactly what the session is meant for. If you have already done a startup investment, I hope you can still learn something new. First pitfall as an angel investor is that you don't have enough deal flow. Now, why is this important? Deal flow means you get presented opportunities where you can invest. And if you are very new to angel investing, often the first deals you get from somebody that is close to you, and that person just walks up and asks, hey, do you want to invest in my startup? Or maybe you know some relatives or some people from the workplace where you are that approach you because they think you can help them, hopefully not just with money, but maybe with something more like business network or entrepreneurial experience. But the problem is if you have very limited deal flow, you cannot compare on what is out there. You just pick from a very small set, and then chances are that the really interesting deals, which have a huge potential, they will never get to you. And so if you really want to do cherry picking and pick the best, you need to have a large enough selection. Now, how can you fix that? The obvious thing is you're very outspoken. You tell everybody that you want to invest, that you are now into angel investing. You can do that on social networks. You can do it in your business networks. And if you do that, you're going to have a big hobby very soon because everybody that learns about that, of course, wants to get some money from you. It has also a disadvantage that suddenly you're very much exposed as an investor, and people expect you to answer if they approach you with an investment deck. So you're going to get a lot of contacts on your social media channels. You're going to have your inbox full with business plans, and then what do? You need to triage them, assess them, go into due diligence, and then also give them an answer. So this can turn out to be quite a large extra time commitment, which you maybe did not expect. And yeah, everybody then knows you're investors, so maybe you also get people asking for money for other things than for startups. And you need to be prepared that most of the startups that will approach you, you will have to say no, because you cannot invest into hundreds and hundreds of startups. You don't have enough time, and often you don't have enough money for that, right? So you're going to disappoint a lot of the people that ask you for money. Then another thing is you just go to a large startup event where there's lots of startups. Many of them have booths or workshops or sessions. Some of them have pitches. So you're going to get the real vibes of the startup community. That's cool. You're going to meet a lot of interesting people. But afterwards, you're still alone and you need to decide who you want to follow up with and where you want to invest. And often you don't get all the information at the event, which means you're going to get the pitch deck afterwards. You need to look at them. And you're all doing all of that on your own, right? Because you went out there on your own and yeah, now you need to do follow-ups on your own. That also creates quite some additional time commitment. And in the end, you're still the only investor on that deal. And you cannot really share the workload with others. Now, let's talk about pitching events. There's another poll. How many startup pitching events have you attended so far? Is it none? Is it one? Or have you been to more than one where startups presented a business case to an audience that could potentially invest? So please bring up the poll and then you can vote on it. So now the poll should be visible. Please pick the one option that fits your answer. Okay, 10 more seconds, then we're gonna close the poll. Okay, fantastic. So many of you already have been to pitching events. That's great. But maybe you were not sure how to select the best. Sometimes it's overwhelming because there are so many startups that pitch and all of them sound amazing. But to really understand them, you need to dig much deeper. But there are also some of you, like 22%, that have never been to a pitching event. So there's the chance you're going to have a lot of opportunities to do so. Here's a slide with lots of events that happen all over Switzerland. And they're organized by different stakeholders. We also organize events all over Switzerland, from Zurich to Bern, Lausanne, Geneva, sometimes even Lugano. But there are also organizations like Startfeld in St. Gallen or ETH Zurich, the Entrepreneur Club, organizes the launch event once a year. Or there's Startup Days in Bern coming up next week on 21st of May. There's Startup Nights in Winterthur, which are going to be the last time this year in Winterthur. They're going to move to Zurich next year. Or there's Start Summit in St. Gallen, which is a really large event in the Olma Hallen. And there's also events by some universities like EPFL, which has their own Investor Day. So if you want to go to a pitching event, you're going to find one close by. And I definitely encourage you to do so because it gives you a good idea on what the startup scene is all about. This is an impression from an investor day that SIGTIC organized at the Swiss Stock Exchange in Zurich. And this event was all about fintech. And there we had startups on stage and investors in the audience and together with some panels to show you some ecosystem trends. So these events, when we organize them, typically we have between 100 to 150 investors in the audience and around 6 to 8 startups on stage. Sometimes we have more if it's a longer event. Now, if you join an angel investor club, you can actually solve 3 problems that you might have otherwise if you do it alone. One thing is you get much more deal flow, and the deal flow is already curated, which means you don't get to see every deal. You only get to see the deals where the team and the business has a good potential. And that work is typically done by a jury, which looks at every case, has a lot of experience, and then tries to rate these startup cases in different dimensions. So at SIGTIC, we have 4 dimensions we look at. One is the team potential. The question here is this the right team to actually build the product and sell it and make the company big? Then we look at the business potential, like how big a business can this be? Is this really something which is in high demand? Will somebody pay for it? Is the market large enough? And with large, that typically means, is it possible to generate 100 million revenues with this solution? And if the target market is too small, that this is not possible, then the question is still, is it scalable enough? Is it interesting enough? And will it ever get venture capital? Because most venture capitalists, they also look at the market size before they invest. Because if the market is not large enough, For them, it's not interesting enough to invest because they want to invest in a thing that can really be a market leader and can make large enough revenues to be an interesting candidate to be bought by another company in an M&A deal or go on the stock market. And the third thing that you win when you join an angel investor club is that you don't need to be publicly exposed as a single person. So you don't get directly exposed. You just are within the investor community. And then it's not that people go straight to you and send you deal flow. No, you get it through the club. And then you can look at these deals together. So you can do due diligence together, which means you can split the workload. You don't need to look at all the documents. You can just look at things that you have the most experience in. And that, of course, helps a lot to balance the time that you need to invest and also have a much larger selection of interesting deals. In addition, we get a lot of signals. If you see a lot of other people also like this deal, chances are there's something to it. And so you can direct your attention towards these startups, which seem to be more interesting than others by profiting from what other investors do. So you can share a lot of the workload and you have better chances to really find one which fits what you like and also what others like. So you will not be the only one on the deal in the end. It also means that typically if you do that, join a club, you have an idea that you want to build a startup portfolio, which means you're not going to just invest 1 or 2 times. You're going to invest maybe 10 times, but you do that over many years. So you can stay in a club for 5 or 10 or 15 years and build up your portfolio, 1 or 2 startups at a time each year. So that should be your perspective, because investing in a single startup, just a one-off, to have a startup investment because it's cool, chances are you're going to lose it because there's quite a high failure rate. So if you don't spread out and have a larger portfolio, it's extremely risky to invest in the asset class of startups. That's why most angels go for 10 to 20 investments over their lifetime in a club, which is typically between 10 to 15, maybe 20 years. Now at Zictic, we have our deal flow not just at our events, we also have it in our database. We have our own deal room, which runs in your web browser or on your mobile phone. And we have more than 1,000 deals in it. And each week, new deals come in. Every year, around 700 new deals are added to our database. And this is done by the founders. And then the jury picks the best of them to come to our events. So there are many more deals in the online database than there are on our events. We present around 100 to 120 startups every year on stage. But in a database, you have about 600 to 700 new deals every year. So you see there's many more deals out there that you can also connect to if you want that. Now, we also have quite a strong footprint in Switzerland. Everywhere where you see a dollar sign, that's a city where at least one Zictic angel investor is living. You see a lot of them in cities around Lake of Zurich. You see several of them around the Lake of Geneva. But you also see some in Ticino, around Bern, or around Basel. So there's quite some clusters where we have investors, but ultimately anyone can join, also people from abroad, not just from within Switzerland. And startups that we invest in, they need to have a connection to Switzerland or to Liechtenstein, which means typically they have the operations here with the core team, which means the decision makers are here, but ultimately their markets will be global. So there needs to be this connection because our angels, they typically have a strong network within Switzerland, so they can help these startups in the early phase to find the first client, maybe find some talent for the team. And in that phase, it's really crucial that people that have access to clients help the startup to help them find out what is the right product to build and how can they make the product more valuable, such that later when they go international, the product is already on a high maturity level, such that more clients will buy it and the sales process is already established. So that bootstrapping phase or product market fit finding phase is actually the most difficult phase of a startup. And this is where angels can add much more than money if they can help the startup to find out what is the right product, what is the right pricing, to which clients you should sell. All these decisions are quite difficult. And it helps a lot if you have experienced people around you, such that they can really help you in this difficult phase. So there's a question in the Q&A. I see, how are the risks evaluated by the jury? So what the jury does is basically they do a pre-assessment. They look at the team and they see, for example, do they have different skill sets, different experiences, or is it just everybody from the same university, same age, same background? And typically for building a startup, it helps if you have diversity in the founder team and everybody has typically a strong background to show that they're entrepreneurial. Now, if you want to look at the risks, typically you can only do that if you have full access to the data room. And in the first stage, we only have a pitch deck, which is a very short summary of the business case, typically 10 to 15 pages. It outlines all the core things, but it doesn't go extremely deep. It doesn't show full financials. It doesn't show like client agreements if you already have them. It doesn't show the full product. If you want to assess not just the potential of the business case or the team, then you do the due diligence, and that typically happens after our pitching events, when the first investors find it very interesting to follow up, and then the startup gives much more information to those investors, a subset of our big community, that actually want to assess opportunities and risks. And in this assessment, they go into many more details. We have a checklist which goes into several different topics, for example, liability, intellectual property, also like the client base, for example, the pricing and so on, or how is it deployed? Is it in a scalable setup and all of these things? And if you have gone through this due diligence process, which happens after our pitching events, you definitely have a better understanding of how the risks are positioned. Every startup is different, which also means it's good to have topical experts which know the industry, also know competition. And sometimes we also do technical due diligence. We have people that work in a day job as software engineers, for example, and they can even look into source code if there's already source code available. So it's quite a lot of different things that you can look at. In the end, if the startup is super fresh, super new, there's not too many things already out there to look at. But if a startup already has 1 year of business, they typically have something to show where it can look very deep. The nice thing is if you do that due diligence process in a team, you can share the results. So you get a much more comprehensive picture of all the opportunities and risks than if you try to do that just alone, because often you don't have the experience in all the fields, and often you don't have the time to go really, really deep if you do it alone. Now, besides doing pitching events, we also have some social events. For example, once a year, we invite more than 200 angel investors and their partners on Panterei, which is the largest boat on the Lake of Zurich. And there, basically, it's a flying dinner with some entertainment, and people can get to know each other also socially and connect to each other, share experiences, and just have a good evening. In terms of the process, how does it work to invest? So once the jury has selected startups with high potential out of the roughly 700, they select them for the next event and put them on stage. That's our SIGTECH Investor Day. And on this day, you hear the pitches. There will be some Q&A from the audience, and then there will be an apéro where every startup has a booth. And there we can engage directly with the founders face to face, because in our setting, always one of the founders is on stage and pitches the startup. So you really get to see the people behind these businesses. It's not anonymous. It's really, you're going to feel the team. You're going to reach out to them directly. Or if you cannot come physically, you can see them on the live stream. And then you can follow up afterwards. And typically the things that come after the Investor Day, they are virtual, so anybody can participate. So we have a deep dive and a due diligence meeting that are happening afterwards. Once at the day you're interested, that you want to follow up, you just basically mark your interest in our Dealflow platform, or sometimes we have also a special forum. for people that are not yet members. And then the startup team is going to invite you for a session called Deep Dive, where you get to know the team and the product and more in-depth information about the business case. It's typically a 1-hour session online, and often in that deep dive meeting, one of the investors that is interested says, okay, I will coordinate all the investors and I take the lead as the deal lead to move the process forward. So we can organize the investors with the primus inter pares, which is also an investor. So we don't have people that play the deal lead, which do not invest. They have to invest to be deal lead. So they put the money on the table and say, I go in, and others also want to go in, and he coordinates that or she. And then the next meeting is typically due diligence, where you have access to the full data room. Sometimes the startup needs a few weeks to prepare the data room. We tell them which documents we want to see. And based on that data room, it's just basically typically an online folder where you can look into all the relevant, like the work agreements they have, the customers they have, if they have intellectual property, trademarks, patents, whatever, if they have more detailed financials, all of that you're going to find. And then the due diligence process happens. We have this checklist, as I said. We have some nice templates where people can collaboratively fill in their findings. And then you're going to negotiate some terms. We have some templates for that as well, for term sheets. There's also legal documentation that you can use, which has been written by lawyers. And based on that, you typically end up investing in the company through shares. Or you're going to invest in a so-called convertible loan, which is typically a debt, which is going to convert in 1 or 2 years into shares. So in pretty much all cases, you're going to end up being a shareholder of a non-listed startup, which typically is incorporated under the jurisdiction in Switzerland or sometimes also in Liechtenstein. So that's the whole thing. Some startups are very well prepared. They already have a term sheet. They already have subscription agreements. Others, they have nothing of it. And then the deal lead basically takes on the job to create a term sheet and come to a conclusion and negotiate the deal. Now, who is actually allowed to invest in a startup? So who would you think is allowed to legally invest in Switzerland directly into a Swiss startup? Is it qualified accredited investors? Is it anyone who has a wealth of at least 2 million? And that was maybe a little bit quick. Or is it anyone who is of full age, which is 18 in Switzerland? So make your choice. Who is allowed to invest in Switzerland in a Swiss startup directly? In the meantime, I see there's another question. What's the minimum ticket size? At SIGTIC, we say if you want to invest directly into a startup, it's 20,000 per deal and investor. You can also invest more, 50,000 or 100,000. Typically, the rounds are around 500,000 Swiss francs to 1.5 million, rarely 2 million in total size. And sometimes we also have professional investors or venture capital funds joining the same round with angels. Sometimes we have 500,000 from angels and 1 million from VCs or corporate ventures or family offices. If you want to invest less than 20,000, we have syndication. So there you can also invest 5,000 or 10,000 in a deal, but then you're going to be joining a syndicate together with others, and the syndicate then has 50,000 or more in it. There's a question about Liechtenstein startups. Yes, they do qualify. They can also apply to us. We also have a club which we collaborate. It's the Business Angel Club Liechtenstein, BACL. We also exchange deals with them. So yes, Liechtenstein startups can also apply to SIGTIC for funding. That's correct. Okay, make your choice. Then we can close the poll. 3 more seconds. Then let's see the results. Okay, a lot of people said anyone of full age, and this is actually the correct answer. In Switzerland, unlike other countries, like in US and UK, you have to be qualified or accredited, otherwise you're not allowed to invest. In Switzerland, anybody is allowed to invest. So even a student is allowed to directly invest in a startup. You're not allowed to invest indirectly, which means you give it to some special purpose vehicle or a fund. and then the fund invests. So if you basically delegate the decision making on where exactly you invest by giving your money to a fund manager, and then the fund manager or the investment committee of the fund makes the decision, then that would not be allowed unless you are a qualified investor. But with what we do at Sicti, we present to the startups, they come on stage, the founders present it, and then anybody can directly invest with them. That's quite liberal. In many other countries, that is not possible, as I said, because there you need to be accredited. That typically means you have quite a high income or a high wealth. And if you don't have either, you need to have a lot of know-how. For example, you have done education as an investment banker, and then you would also be allowed. So that's the typical thing that you need to be qualified or accredited. So you don't need to be a millionaire to invest. And a lot of people that are in our club, they are not extremely rich, but they have quite some money from their earnings, and sometimes they have a bonus. And if they get their bonus, they want to invest 20 or 30 or 50,000 into a startup. So, and if you do that once a year or every second year, you can decide when to invest. You don't need to have all the money in the first year. You just need to have money once in a while. So a lot of people do one investment a year, that's it. Sometimes even only one in 2 years, and that's also totally fine. Because you learn a lot by looking at many deals. Maybe in the first year, you shouldn't do more than 2 investments. Just look at lots of deals and then just pick the one that you really like. The worst thing is you go in the first year, put all your money in whatever startup comes around, and then in the second year, when you really understand how it's working, you cannot invest anymore. And I need to wait for quite some years until the startup is sold and you get the money back to become again an active investor. And you don't want to be paralyzed, right, by having put all your money into the startups too early. So I rather recommend doing it slowly over multiple years and learning every year, get to know new investors, forming groups with co-investors, and then the thing is much more fun. There's another question from Susan. Do you have an industry focus or do you invest more broadly? So Sicti invests now in pretty much all verticals. We haven't done a lot of biotech, and we don't do classical investments, like we don't do real estate or like established business models, like we don't invest into like hotels or restaurants. So what we typically invest in is startups which bring an innovation from universities or from research into the market. So they typically develop a product, and many of them are B2B, so they develop products for companies. About 2/3 of our deal flow is B2B, and only 1/3 is business to consumer. But generally, we're agnostic to the industry. We just want to make sure it's something that really has a high degree of innovation, and it's a big step forward. It's not just like 3% cheaper than what's already out there. So we want to see a real big innovation, and that's the thing we look for. Okay, then there's another thing which is also connected to the question we just got. What's the difference between a small and medium-sized business and a startup? And the main difference is that a startup must scale very, very well and very quickly, because otherwise you're going to be the first and the last investor. If a startup needs 10 years to do 1 million of revenues, you will never get venture capital funding from the big funds, because they cannot wait 10 years for you to make from 1 million to 5 million. It's just too slow for them. They want you to triple or quadruple like every second or third year with your revenues or your user base. Otherwise, it's not interesting for them to invest because you're too slow for them. And here's a list of 6 things that if you have all of these 6 things, then you should be considered a startup. And this definition is from the Startup Radar, which is a publication by Startup Ticker, where basically they give you a lot of statistics around where the founders come from, in which verticals you see startups in Switzerland, and give you a better feeling like which universities these founders come from and what type of businesses they actually have. So if your solution is based on science and technology, if it has a strong focus on innovation, if it's really highly scalable, which means you can serve many more clients without adding a lot of new headcount to your startup, That means scalable, and you don't need a lot of money to scale up. You're very cost efficient when you scale up. Then you need to have really high ambitions to grow and to go global. So you cannot just stay in one canton or in one country. You need to go to other countries. And that needs to be reflected in how you build the business and how you push it. And because Switzerland, for most startups, is too small a market, there needs to be international demand for your solution, not just local demand. And ultimately, you also need to work with investors that actually want to make a profit. And that's another sign that you have a startup. If you have only investors that, because they're partners, they put some money in, but they don't really expect to get the money back anytime soon, then typically that's not a startup. That's more an SME run with partners. So if all of these six things are fulfilled, then you typically have a startup. But you also see it's not black and white. There's just indications that it's rather a startup than not, but I think the scalability point is maybe the most important one. Large market, highly scalable business model. So again, here I compare small and medium-sized businesses with startups. And on the startup side, as I said, super scalable, whereas some SMEs, they rather want to make a few customers extremely happy, build bespoke solutions for all of them. Or sometimes it's very people intense. So to have more, serve more clients, they're going to add many more people to the organization, which is also not very scalable. Then startups have a product focus, where my SMEs often have a project focus. Every project is different. They don't really sell the same thing. They do more a service or a project than they do a product which is standardized. A product is the very same thing for a lot of clients. So you change it once, all the clients get the new version. You can't do that with projects, and you can't do that with highly modified products where every customer is basically a different product. That's not a product business. Then, yeah, the market needs to be large. I already mentioned 100 million recurring revenue, or ARR, as some investors call it, annual recurring revenue. The fast growth, there's some metrics here. Some VCs want you to have revenue growth every month of 10 to 15%, which is a lot. Or over the year, the rule of 40, which is a combination of your revenue growth rate in percentage plus your profit margin in percent. That's a typical metric if you are a software as a service business, and VCs look at that. And if you hit it, the rule of 40 or are above, a lot of VCs jump on you and want to invest because this is the growth that they really like. Now, with SMEs, often revenue growth is not a priority because they want to minimize risk, and you don't want to go global. And you can still do an amazing service locally, of course, but then you're not VC compatible. To get money from them will not be a good choice. If you also have unique selling proposition, which makes you very special, nobody else can copy you, that helps a lot. And for early investors, typically, if angels go in, they need to see a chance that the valuation of your startup can be tenfolded over the lifetime until they exit, because they're going to get some dilutions as well. And for VCs, they typically look for at least an increase of the valuation of the startup when they go in until you sell the startup about 3 times. So they can make their investors for the fund also happy. And with startups, the goal is always to sell the company, not just the product, but the company, either through an M&A transaction to a bigger corporate or by being listed on a stock market. Sometimes you invest in a startup and then it turns out that it cannot reach the growth. It just stagnates. Revenues don't go up anymore. It just stays flat. And then ultimately it can be you end up with an SME which you can never sell. So you're a shareholder of a company which maybe never pays dividends and will never be sold. And that's not what an investor wants. They want to buy the shares and sell the shares. And the reason they want to do so is because if you sell the share, you have free capital gains. There's no taxation on capital gains in Switzerland. So it's a very interesting way of generating returns. Now, let's look at failure rates. What do you think? How many % of United States-based startups fail in the first 5 years? And these startups all have received at least once a check from a venture capital fund. So you can pick the failure rate. So 55% go out of business after 5 years, or 65% or 80%. What would you think? And this statistic is for Silicon Valley startups in the US. So make your choice. 10 more seconds. In the meantime, there's a question, how many startups did I exit successfully? So I've done about 42 investments at about 15 exits, and 10 of them were successful exits, and the other 5 were not so successful. That's my personal statistics. But I still have many more in my portfolio. Not all of them have been sold because it quite takes a while. In Switzerland, on average, about 7.5 years from incorporation to exit. That's the average time to exit. Okay, we can close the poll now and show the results. Yes, so most of you guys know that it's a very high failure rate in the US with 80%. Yeah. So let's see how this is doing in Switzerland. This is the statistics which were done last year by Demand Sage, and they looked at all the big startup hubs and what happened 5 years after incorporation for those startups that got at least one venture capital investment. And now what you see here is US has the 80%, as we have just seen in the poll. Interesting enough, Switzerland has only 65% of startup failure rate, which means if you have 3 investments, one of them survives and 2 of them die, or you don't get the money back. Now there's a question from Ardiana, what do you do if your startup turns out to be an SME? I mean, ultimately, if you want to get the money back from a startup that is never sold, and they don't give you dividends, I mean, there's 2 things you can try to do. One is you convince the company to buy back the shares. They can do so if they make enough profits that the company can use the profits to buy back the shares. Or the other thing you can try to do is you can find another investor that wants to have these shares for whatever reason, maybe because they want to be close to the founders or have more voting rights at the General Assembly. And if that also doesn't work out, the last thing is you can try to convince the management team or the founders to buy the shares back privately. And there's a thing called leverage management buyout, LMBO, which means they're going to go to get some credit from the banks. And with that, they can buy the shares, and then they're going to pay back the credit from the profits of the company over the next, whatever, 3 to 5 years. But other than that, there's not a lot of options to get rid of your shares if the company isn't really sold. So, and Charlene has another question. If I want to invest in a startup as an individual, what's the normal ticket size range? So as I mentioned previously at the beginning, it's 20,000 per deal and investor. And typically people do 1, maybe 2 deals a year. Very rarely to do more. If you want to do less than 20,000 per deal, then you would go through a syndicate, and there you can start with 5,000 minimum tickets per startup you want to go in. And of course, you can also invest 100,000 or 500,000 if you have that. But as I said, our rounds typically we do the first and sometimes the second round of a startup, and these rounds tend to be less than 2 million in total size. Often it's around 1 million. And you do that together with others, and some people do larger tickets and others do smaller tickets. So it's always a mix. But you should definitely plan to do several investments, not just one. So don't put all your money in one single startup and then pray for it that it survives. It's not a good strategy. You need to have a diversification. So go for 5 to 10, better 20 startups over 10 to 15 years. What is the reason why startups actually fail? They asked a lot of failed startups, 111, and this was done by CB Insights. And they asked the founders and the VCs what went wrong, and they could check all the boxes which you see here. So you could give multiple answers what the reasons were. That's why these things don't add up to 100 in total. But what you see is obviously most run out of cash, and then they cannot pay the employees anymore, and then they go bankrupt or need to shut down. But the reason number 2 is there's no market need. So they have a product which nobody wants to buy. And that's the thing that you can avoid as an angel. So if you help them find prospect customers faster, talk to them and listen very carefully what they really need, then you can make it a better product such that ultimately you're going to have product market fit. Sometimes you're also just too slow, so they get outcompeted. 20% said, yeah, the competition was too strong, they were better. Or sometimes just an existing big player just added a new feature, and then the startup went out of business because it wasn't needed anymore, right? So there's lots of reasons down to the founders have a burnout, or they try to pivot and create a new product, or just they never really shipped something that was working. There's a lot of reasons that can go right. Something is just the pricing or even regulatory hurdles. There's a lot of things that can go wrong. Now, as an angel, you can see many of these things before the founders can, because you hopefully have more experience in your industry. And that's exactly why angel investors are so important to put down the failure rates. If you want to read more about venture capital and startup angel investing, there's lots of books out there. Swiss Venture Capital Report is available for free. All of these publications are available for free online, and some of them we also have paper copies, so investors can get them through us. Like there's a book around product market fit, or Swiss Venture Capital Report. We also have some printed copies. Angel Handbook gonna be a new edition this year, which we're gonna print again 5,000 times, and gonna give it for free, so you can learn a lot about all the basics and how to invest and how to become a better investor. There's a couple more questions that I see before I'm gonna conclude. So what stage does Sictic usually invest in? So we typically invest in the first or second round after incorporation. So we are very early stage investors. We now also have a program for startups that come back, like after some time, they already are 5, 6 years old, like scale ups, and for them we have special formats to come back and raise some larger rounds, often together with institutional investors. Now, another pitfall is that you underestimate the startup potential, because people think, yeah, I don't really know successful startups, founders are not in the media, I only hear about failures in the media or scams, so they don't exist. So here's an example of a Swiss startup that even incorporated, called Conto Vista. They made a new feature for e-banking clients, and they sold it to 25 banks in just 4.5 years. And people could manage their cash flows and better understand the spending behavior, and the bank would get some insights on what type of products the clients actually would need in the current life situation. Now, if you had invested in the first round, called the pre-seed round, you would have gotten 32.9 times the money back after 4.2 years. Or if you had invested in the seed round, you'd have gotten 13 times the money back. If you invested just before the exit, 1.3 years before the exit, it would have been 2.3 times the money back for the angel investors. So overall, if you invested the same amount in all of these stages, you would have gotten about 8.6 times the money back. Or if you had it on a savings account, that would mean an interest rate of 115%, which is quite nice for returns. There's another one, which is an actual scale up in Switzerland. So what you see is the headcount on the left side, and on the right side, you see the development of the revenues, the annual revenues in millions. So they made 73 million revenues in the year 2025. And in the year 2022, they made half as much revenue with 35 million. The interesting part here is that the revenue is growing very nicely, very steeply, whereas the headcount is pretty much stable. And this shows that this startup really has a highly scalable product, where it just basically can sell more with the same number of people, because the product itself is so well done that you don't need to increase the headcount to serve twice as many clients. So this is what you look for if you invest. You want to have such a case where you see it's super scalable and highly profitable, and such a startup is quite easy to get venture funding for, and also easy to sell. Now let's do a last poll about returns. So if you invest in funds, which invest in many startups, typically about 20 per fund, are the funds of US or the US-based venture capital funds giving more returns, or is it European Union based venture capital funds? So if you think US performs better, check the first one. If you think it's the European Union venture capital funds, pick number 2. So 3 more seconds and let's close the poll. Okay, I think you can close, show the results. Oh, it's about 50-50. Most people actually, think it's US-based funds. Yeah, that's not true. I looked at the figures for the last 15 years, actually 20 years even. So if you look at funds that have been running for the last 10 years, last 15 years, last 20 years, you see what the annualized returns are. And in the last 20 years, you see Europe was slightly below, but in the last 15 years and the last 10 years, Europe venture capital funds actually had average returns which were better than US. So that's the untold story that Europe has changed a lot in the last years. It's not just Silicon Valley that has great performance, it's also now European startups. So just keep that in mind when you compare different markets. Just because Americans are more outspoken doesn't mean that the story they told 20 or 30 years ago is still the same one today. Also, if you were to invest in AI startups, you could invest in those which are public on the stock market, like Google or Nvidia. If we had done so, beginning of 2025, 1st of January, and then kept that until end of the year, you would have had a nice increase of around 39% of the value of your investment in the stock market. The nice thing, if you go to the stock market, you can always buy and sell whenever you want, so it's a very liquid market. If instead you had access to the 10 top AI companies which were not listed, you would have gotten 200% increase in valuation, which is 5 times better than what was on the stock market. And this just shows investing in private markets is extremely lucrative if you have the right access to the most interesting companies. And the same thing is with startups. They are not publicly listed, so you need to have access to the deal flow, otherwise you cannot invest, right? So, and the last thing I want to bring up as a pitfall is sometimes you get pushed into a startup investment. People call you up on the phone and say you have to invest now because next week you're going to increase the share price, often for no good reason. They just want to push you, create some fear of missing out. Or sometimes it's a founder that is super pushy. It doesn't really want to give you time to look at a data room, or it just claims somebody else has already done due diligence, even though that might not always be true or not fully true. So the good rule is always, if you get an investment, sleep over it and then decide the next day. And the reason is, it's like, I mean, you wouldn't marry a person you just met the first day, right? Because investing in a startup is a long-term commitment, often 5 or 10 years. And you might going to regret it if you didn't listen to your gut feeling in addition to your head. And if you sleep over it and the thing is still there tomorrow, then maybe it's also much more serious than if you get pushed into it and have to decide right on the spot. So what you see in TV with Höhle Löwen and Shark Tank, that's not how people invest. This is just entertainment. And most of these deals which I do on stage are canceled the next day. In the Swiss TV show, typically 2 out of 3 deals are canceled the next day. In US, it's like 80% get canceled, but on the stage, it looks amazing, as if they were to invest like spontaneously and put in lots of money into everybody. So if you keep to some golden rules for angel investors, first of all, select very wisely where you want to invest, because you want to add more than just money. You want to open your business network. You want to share your entrepreneurial experience. I can only do that in certain type of startups. So be smart on where to invest so you can add something extra than just money. And you don't go into a deal alone, because often if you're the only one liking it, maybe it's not the best deal anyway. And you would also be the only one to give money again if it doesn't go according to plan. And I would never rush and skip due diligence. Always talk with the founders, look at the documents, get a good feeling, and try to really understand what they're up to and if this is the right team and it's the right time and the right product. Take some time to get to know the founders and don't get pushed into it. Of course, there's also legal stuff you can look out for example, liquidation preference, so you get the money back first before anybody else. Because your money is full at risk, where the founders, they put in their time. If you have founders that might break apart, it would be great if you had some vesting, such that if one founder leaves early, some other person can come in and take over the shares. That's typical clauses that you always want to have in your shareholder agreement. So you have a downside protection of these 2 cases when they shut down early, that you get the money back, or if the founders go different paths, so you can continue and don't lose everything. So yes, next steps for you. I mean, you can sign up for the free newsletter. If you haven't already told us which investor you want to attend, we give you a free access to one of our investor days. So you get to see startups, get to know the community. And if you want to sign up to become an actual investor, we also waive the 500 Swiss franc sign-up fee. And you just mention Angel Training as referral, and then you get the sign-up fee waived. Okay, with that, I'm at the end of the session, and I'm going to go through a few of your questions, and then we're going to close this webinar. There's a question: is there any available funds to invest in VC or angels? I mean, typically it's angels investing into startups directly. And if you want to invest into a VC fund, I mean, that's your own decision, of course, where you want to put your money. Some people also have both. They have an investment in a venture capital fund, as long as they are accredited investors, and they do some direct investments. Some people do that because of time. It needs more time to invest directly into a startup than just to give money to a fund manager and then wait for the reporting to happen. Then there's another question: what is the best way to connect with more experienced investors and participate alongside them in the first deals? I mean, this is exactly what you get if you are in an angel club, because then you come into a process where other people join the same due diligence calls and deep dives. So this basically starts at the Sichtec Invest Day, and then you say, I want to meet them again. And then you're part of that group that goes into that specific deal. That's typically the best way to do so. Or you just approach some people where you know they have a large portfolio and ask them the next time they go in the deal if they want to take you on the ride, if you happen to know these investors. Then other question is the involvement as a business angel purely financial, or do you also take on operational roles? And if multiple business angels invest, how does that typically work out? Any of them gets involved operationally, or does it stay purely on the capital side? I mean, typically really operational, like having a day job, is a very different thing than being an investor. But what some angels do, they join the board and they have a bi-monthly meeting with the founders. So they help them to shape the strategy, to prepare the most important decisions. Making the decisions should be with the founders, but if you're in the board, you can help them prepare, come up with good questions, do some research. If you want to be the part-time CFO, then you should get a separate agreement as an employee. Maybe you get some incentives, like to get some more shares, for example. But typically, angels are not operationally in startup, they're more strategically involved. And sometimes the founders calls them up and ask them for an introduction to a client. Or sometimes they ask you if you know somebody they could hire in the management. So try to be helpful when they call you, but you don't have a day job just because you invest in a startup. Otherwise, you would be basically an employee, right? So I would try to be not too operational, keep it on the strategy side. Then was it founders that reported these reasons? I assume this is about the failures. It's both VCs and founders that could report the reasons. And running out of money, I mean, that's pretty obvious because if you don't have more money, then you cannot continue running a company. And then you basically, if you're out of liquidity, you have to go to the judge and shut down. Let's go to the next one, maybe. The VC returns comparison, I mean, these were all done in US dollars. They were, because there's more data for the US market than for European market. But to make them comparable, they compared US dollars with US dollars for both European and US VCs. And this was actually done by European Investment Fund, EIF. They published a study because every investment they're part of, they also get the return investment figures, which otherwise often will be private. Then can somebody invest through a company instead of privately? Yes, of course, you can do that. Some people, they have a GmbH or an AG as a holding. That's totally doable. If you have an operational business and have some spare money, you can also invest as a company into a startup. That's totally doable. There's nothing that blocks you. We have quite some investors at Sichtec that have their own consultancy, and out of that, they also do some investments. What was your main highlight during the years you have invested? I think I have more than one highlight. I mean, one of them was for sure a Beekeeper. Very nice startup. They were merged with Lumapps, and at the point when they did their merger with Lumapps, they had a valuation of 1.1 billion and were serving about 7 million clients together. and they now want to do an IPO as this double company in the next 3 years. Another cool company I'm part of is Frontify, which is growing really nicely. And another one is DeepJudge, where they raised 42 million last year, the valuation of 300 million to change how lawyers are working with AI. There's quite some cool ones. Sictic also did invest in the first round of Get Your Guide, for example. So there's quite some nice cases that we've been part of, or Lake Hero, which was sold within 4 years to Checkpoint for I think 300 million just after 4 years after incorporation. There were quite some really nice ones where Sictic investors were extremely close to. Okay, then there's a last question. Does the Sictic community of investors support portfolio management? We don't do like your tax declaration, and we don't really manage a portfolio because typically when you invest, you're the one having the shares and not the club. And if you want somebody else to get exited, you will need to make sure that confidentiality is preserved. So we don't do portfolio management as a fund manager does it. If you want somebody to do that for you, you better invest into a fund. But we do not offer that service. Everybody that invests does the portfolio management themselves. There's another question. Do you have experience in investing in biotech startups? Any insights due to different timelines? So in the past, there's very few biotech investments that our investors have been involved in. The reason is many of them need like 15 years plus to go to market to see whether the thing actually works that they come up with. They need to go through a lot of clinical trials. That's why for most angel investors, this is a too long-term game. It's more a thing for family offices, which have more stable structures and have a very long-term horizon. From time to time, you have lightweight biotech stuff, like enablement stuff for biotech, which is more data-driven, maybe AI-driven. Some of these we have seen. But typically, biotech is not an extremely good fit for angel investors because the holding periods are too long, and most angels don't want to wait 15 years or longer to understand whether they get something back. Good. Okay, with that, I think time is up. Thanks everybody for joining, and wish you a great afternoon. Bye. Thanks.